I've received yet another typically really bad portfolio to analyze for someone. Let's just dive deep into it. Now, this is typical of the kinds of portfolios I'll receive, and it's not the fault of the individual. This is for their pension, and several mistakes come to mind here and why their pension will be underperforming. Now, first things first, they've clearly gone for a whole bunch of name recognition companies. These are names that are on the high street that they'll have heard of. Now, nothing in and of itself necessarily wrong with that. What concerns me about this is that, okay, so they've got 12 stocks. Again, in and of itself, nothing necessarily wrong with that because they've got a bunch of funds, and we'll deal with the funds later. What worries me about the individual stocks that they've got is that they're just not ticking enough boxes, and there's so much more they could have chosen from. When I'm selecting stocks, we go through a portfolio of 10,000 companies. That could be in my SIP or ISA or junior ISA. And then analyzing those 10,000 for their valuation, we need the valuation box ticked. Are those companies undervalued? Are they growing in revenue and earnings? None of this guarantees the stock price will move, but we know from Nobel Prize winning academic research that actually that leads to a higher probability that the stock price will rise than if it was overvalued and was growing poorly. There are exceptions to the rule. Nothing is guaranteed. However, we're playing the odds. So we want to tick valuation, we want revenue growth, we want dividend yields. We want to look at the company's cash flow and look at cash return on capital invested. Now, if you've got $50 million, Goldman Sachs will do that for you, but this is the formula they use, CROCI, cash return on capital invested. And you want the company to be in the top quartile because those are the companies which as a basket generate 30% per annum. Not every year, not guaranteed, but as a basket on average over the long term, that's what they generate. Now, very few in this individual's portfolio tick that box as well. We need all 5 boxes ticked: value, growth, income, cash flow, recent momentum. It has a low weighting for us, low importance, but it is important. Okay, Sortino, the average return versus the risk of missing it. Why take lots of risk if you're not going to get the return? And outperformance of the market. There are other factors you could look at. You might just gamble on a sector. We don't do that. You might just gamble on what's on the news or a name that you've come across. We don't do that. Obviously, for obvious reasons, that'd be just too ridiculously, well, gambly. So not enough ticking our boxes. Basically, there are many more stocks which would do better for the risk you're taking, the volatility you've got. So to exemplify that, over the last 6 months, the stocks in this portfolio have generated a negative 3% return. Now, that just exemplifies the problem I'm stating, even though one company was up 41%. Because, as I speak, the broader NASDAQ index is up far significantly more than that. And you might say, well, yes, but what about the currency risk, Alpesh? Well, -3 versus being up, 30%? Even if you just track the index, let alone if you try to cherry pick a few stocks from the index using this approach. And if you don't want to cherry pick, then you just track the index. You might say, well, it might be just a small time period. It might be just a one-off. Yes, it might be. My problem, as I say, with this is it usually isn't. It's usually that people have just picked without knowing what on earth they are doing. And for how long should they hold? Well, this is the flowchart I recommend they use. 12 months and then review. And you might hold again for another 12 months if they tick all the boxes, or if it's dropped, as a rough rule, 25% from the peak since you bought it, but you can always change that to, if it's dropped 10%, you'll sell half, and another 10%, you'll sell half. But some kind of stop loss mechanism and some kind of time limit, okay? And you can always review. You might end up holding the same stock for 30 years, but on the whole, you're going to underperform if you do it this way. Now, let's now look at the various funds. Now, the problem with the funds is this. Again, normally people will pick funds based on the emails they receive. So Bailey Gifford must do a lot of emailing to this individual concerned. And each of those funds will have 50 to 100 stocks. So if you wanted to have a bit more Microsoft or a bit more Costco, well, you've got a problem because you're probably owning through that about 500 stocks. And that means you're probably going to have 0.1% of, say, a Microsoft or a Costco or whatever else. So again, it's a typical common problem. Now, what I say about this is, look, the guy's obviously not going to go bankrupt. He's not going to lose all his money. But if that's the low bar you've set yourself, then you're going to have a pretty mediocre retirement. Because should you have, let's say you just did nothing better than track the NASDAQ, as an example, or even the S&P. Well, could you have between 20 to a 40% return this year, which is not typical? It's unusual, I grant you. Yes. Well, for a portfolio like this, it'll probably take 10 years to get the same return as the rest of us got in 6-7 months. Now, this year wasn't typical. But as I say, these are the problems that people often face with their portfolios, and it's what worries me about when they're looking at their pensions, when they're picking pensions, the name recognition, the narrow group of stocks which are pretty poor, or spraying and praying based on, well, emerging markets sounds good, American sounds good, to a narrow group of fund managers who themselves are underperforming the market, as you can see. I mean, the data speaks for itself. So that's pretty shocking, because we've now had 2021 and 2023, which have been exceptionally good years for the market and people's pensions, where some have doubled their money. This individual will not be part of that. And this individual represents about 99% of the portfolios that I see coming in to me. Sorry. Thank you very much.